Hi, David Basnice here, Chief Economist at Beta Shares. This is a snapshot of my market trends report for the month of July. June, unfortunately, was another negative month for equity markets. The MSCI All Country World Index declining by 7.4% in a total return sense. The highlight of the month was a higher than expected US inflation report, which goaded the US Federal Reserve into raising rates by 75 basis points the following week, so notably higher than what the market expected only a week earlier. That saw bond yields continue to rise, US 10-year bond yields breaking up above 3% through the month. And so continuing to put downward pressure on equity valuations. Interestingly, corporate earnings globally are still rising. Overall economic activity is still positive. I mean, one of the reasons interest rates are going up is that demand generally is still pretty strong. Now, up until recently, a lot of the weakness in equity markets has been in the so-called growth technology areas of the market, which trade at high valuations and are more sensitive to higher interest rates. But we did see a broadening of that weakness to the more cyclically sensitive areas such as commodities. So the Australian resources sector, for example, did have a notable tumble through the month. So the markets are now starting to fear not just higher interest rates, but the consequences of higher interest rates in terms of what that might do to economic growth and corporate earnings. In terms of the outlook, it's still a fairly treacherous path ahead. We do have central banks around the world continuing to talk about raising rates, still fearful of high inflation being entrenched into inflation expectations and then as a result inflation staying higher for longer in the years ahead. So they are looking to raise rates, slow growth, bring down inflation, hopefully avoid a recession. But, you know, as the Federal Reserve is saying, if it takes a recession to get inflation down, then they're not going to flinch. Look, in terms of the Australian equity market, I guess the old adage applies: if the US sneezes, we catch cold. Our market has been reasonably resilient in the first few months of this year, because it was a time where commodity markets have been fairly resilient. If fear of global slowdown intensifies, as I suspect it will, I think we'll see more weakness emerging in our market, sort of a catch-up period of weakness. I do think markets do remain overly aggressive in terms of interest rate increases. The market expecting the federal funds rate of the United States and the RBA cash rate to get up above 3.5% sometime next year. I think growth will slow in both economies well before the cash rate gets anywhere near that. So as a result, the bond markets are starting to look good value at the moment with the overly aggressive interest rate increases priced. Having said that, I think it's still premature to think we're seeing the bottom of the equity market due to the increasing downside risk to the earnings outlook. That's it for now. Thanks for watching. If you'd like to see full details of my report, please visit the Insights section of our website. So thanks for watching, and I'll see you again next month.